maybe I'm just going to take that question in a slightly different perspective, from what these three other panelists have shared earlier. I think I'm going to draw on what Kenneth has presented earlier about history. The reason why the loan market, came back in a very big way, if you take yourself back 3 years ago, actually, the Indian loan market, the ECB market for India, was sort of dwindling to a certain extent because India achieved investment grade ratings, more and more corporates were getting a good rating, and everyone was so happy with the bond market. 0% base rates, right? You're going to issue what? 5-year loan at 2%, 3% coupon, something like that, which was a wonderful place to be. But in 2023, what happened when the rate hikes went up? The bond market was shut. The bond market was effectively shut for over a year. That funding option was not available. So what happened then was people suddenly realized, right, from a point where cost was everything to a point where diversity became important because that was optionality. So these days when I see clients, I always say to them, look guys, I get it, you can manage that mix, but you should manage that mix. You should not cut out one market from the other, even though it's more expensive. So then to answer the question, what do I expect as rates come down? Now, as rates come down, the reality is the bond market will come back in a bigger way, right? But I think this experience that we all had in that last 18 months would shape the actions of a lot of borrowers going forward. I don't think the loan market will dwindle and disappear, but I think there will be a little bit of a shift away from the loan market. At the same time, given where the underlying macroeconomic environment is in India and the sheer demand for capital, like Shram said, one steel plant is $1 billion. He's going to build another 25. There's 25 billion in what, 6 years? Did you say that? 6 years?
Yeah, give or take.
So that's 4 billion a year, just JSW Steel alone, right? So that underlying demand will help to drive some of the loan volume going forward. Few of the segments. What are the segments that are hot? One, and BFIs for sure, right? GDP per capita is only going to get better. People are going to consume better. People are going to start wanting mobility. People are going to start wanting better capital goods, right? So that's one. Two, infrastructure, steel, cement, right? All of these are going to need a lot of growth. The PE guys are going to be buying, the trend that the consumers are going to consume better, basic products, right? Food, basic household products, whatever, all right? Something along those lines. So all those are going to drive M&A transactions in that space because that's a huge potential of growth. So those are the underlying drivers, and those will come back to the loan market in some shape or form. And our mature loans that are going to the typical investment grade borrowers, they're going to start to shift a little bit away into the bond market. So that's how I broadly see things going.